Let's continue how to design a mutual funds portfolio. Okay, let's continue. And actually, this is a video on rules of portfolio construction, and I'm trying to build up series of videos to in this section here how to design mutual funds portfolio. This video is on rules of portfolio construction. Let's continue. Okay, my name is Sarwan Agrawal. Okay, let's go to next section here. Next section is rules of thumb for portfolio construction. Okay, and after that we will do the four more sections here. Let's continue. Let's continue here. A portfolio needs to provide a respectable return at a reasonable risk. We build a portfolio with a risk we are comfortable with, and we are trying to get a respectable return from that portfolio. Okay. So for risk return trade-off slide, we have there is one slide in the fund portfolio cheat sheet video at this location at YouTube. A first variable was allocation to stocks, and this allocation to bonds was 100 minus allocation to stock. Okay, that defines the portfolio. That is our strategic allocation. So our portfolio is governed by our strategy of so much allocation to bonds. Okay, let's continue from here. Further exposure to international stock and can also enhance returns, increase diversification, and reduce risk. Risk is as is measured by standard deviation. Let us continue. Okay, as such, there are two variables we need to consider. How much is allocation to income, and also which by also gives me how much is allocation to equities, and how much is allocation to non-US. In this section, we will discuss allocation to income. Let's continue. Allocation to income section. We can use this return versus risk chart, which I'm repeating again on the next slide, okay, to determine bonds. Okay, allocation to bonds. Okay, we can also use the Vanguard tool or another similar tool to generate portfolio recommendations, and that has bonds allocation, and which this tool uses our risk tolerance to determine our allocations to stocks and bonds. Okay, let's continue from here. Okay, you can also use a rule of thumb age minus 20 for bonds allocation. For a 50-year-old, allocation to bonds would be 30%, and that's appropriate age-based allocation. It used to be for 50-year-old, 50% allocation to income was considered appropriate. Now we live longer, and as such, a lower allocation to income is considered appropriate. You can use another allocation. Okay, you are comfortable with. Okay, let's continue. For this discussion, we will use a 60-40 allocation where allocation to income is 40% and that to equities is 60%. Here's the table I've been talking about, and the first column is allocation to stocks, and bonds are a percentage, and bonds are 100% minus this number here. And here's the return percent per year, and here's the standard deviation of return percent per year, and this is 10-year based numbers, uh, returns and standard deviation, and I did this chart on 14th July 2014. So at 40% of allocation to stocks, returns are 6.75% per year based on 10 years ending in 14th July 2014, and standard deviation is 6.67%. At 40% allocation to stocks, return is higher than the standard deviation is. But at 6.75% per year, a portfolio will not double in 10 years. But when you get 50-50 allocation, returns are 7.1% per year, and at that rate, a portfolio would double in 10 years. And at now we are talking about 8.2% in standard deviation. When you go higher up in the stock allocation, our returns go up, and though marginally, and so do the standard deviation go up, and they go up significantly. Okay, at 50-50, my returns are 7.10% and 100% stock allocation, they are only 8.27%. From 50-50 to 100% stock allocation, I gained 1.17% per year in the return. However, standard deviation more than doubled from 8.2% per year to 17.24%. So it is a matter of how much return you want and how much standard deviation you are willing to accept. At 70-30, it's a standard deviation is 11.55%. Okay, let's continue from here. So I actually find for this range here, 40% stock to 60% stock, a comfort zone, but your comfort zone might be someplace else. Okay? You might be comfortable with this 6.3% per year return, where the standard deviation is only 5.31% or any other number. Why do we do allocation anyway? We use allocation because we do not know the future. Had we known the future, we'll be investing in the assets with the best future returns. The goal of our investing is to build up a wealth as quickly as we can. In some years, commodities shine. In another years, bonds are at top, and still another year, it's large caps are in. Okay, to not to miss out on opportunities, advisors invest in multiple asset types. This is the allocation in business comes in because we don't know the future and various asset classes are on top in various years. There's no patterns to determine when which assets would be shining. So as such, we mix up the and use multiple assets. Okay? And here is the one we need to consider, be really carefully know, understand. Down markets test our tolerance. We all have a great tolerance until it's tested. In up markets, we all have a tolerances. As soon as market turns down, that's the time our tolerance would get tested. As such, we need to carefully consider risk tolerances in building portfolios. We need to have bonds that have been considered as shock absorbers. We need to build up our shock absorbers in our portfolio. Okay, let us continue from here. Okay, so now we are going to go into the next section here. Okay, allocation to non-US. We already know how much to allocate to income, which is either we use a rule of thumb or we use a risk return versus risk chart, or we use age-based allocation or some other allocations method you use. Okay, let's now we would go to non-US. How much of the equities to go to US stocks and how much of that to go to non-US stocks. So there's no consensus on this issue here. Is how much to US and how much to non-US stock. Okay? My opinion, we live in the USA, we earn here, we spend here, and we are comfortable with the local businesses. Most of the US companies are multinational and derive their income from sales overseas. Okay? For income to non-US markets, our own US companies provide some of that because they're multinational and their sales come from other markets. Let's continue. It's my opinion here. We do not need capitalization based non-US allocation. Okay? And non-US stocks do add diversification. So let's look at these all the issues involving various. Let's see what gurus call about this allocation here. Okay? Professor Jeremy Siegel in his book The Future for Investors suggests 40% of equities for non-US stock. That is the ratio of US to non-US is of 60 to 40. We study the lazy portfolio of Aronson family taxable. Lazy portfolio uses allocation of 40 to 30 allocation. US is 40%, 40 and non-US is 30. It's a 40 to 30 ratio. Okay. In model portfolio, Schwab uses a ratio of 3 to 1. So in a Schwab's model portfolio uses ratio of 3 to 1, and that's US to non-US of 3 to 1. And T. Rowe Price recommends a ratio of 4 to 1, and sometimes 5 to 1. Okay, let's continue from here. In a 50-50 portfolio, BlackRock's tool suggested a ratio of 29 to 21, which is the US non-US of 29 to 21, which is 58 to 42. That's 58% to US stocks and 42% to non-US stocks. And it kept changing. That's the one day that's the number it gave, and it might give you different numbers on another day. In a 50-50 portfolio, Vanguard recommended ratio of 35 to 50, US to non-US 35, 15, which is same thing as 70 to 30, okay, 70% to US and 30% to non-US. In a 50-50 portfolio, Fidelity used the ratio of 35 to 15, which is US to non-US, 35 to 15, which is same thing as 70 to 30. So this is the consensus here, and that's what we will be using. We'll be using of 70 to 30, 70% to US stocks and 30% to non-US. We will be using US to non-US of 35 to 15, which is also 70 to 30 in this discussion here. Okay, let's continue from here. With these two numbers, we can construct the rules we need. Okay, so first we will figure out how much large cap, mid cap, and small cap are 70% US and 30% non-US. Okay, so I used the Excel tool. I got the premium version at TD Ameritrade. Okay, it's a six. This thing had a 68.63%, almost 70% in US, and 30.21%, almost 30% in non-US. Large cap was 76%, mid cap is 18%, and small cap is 6%. So that gives me a ratio of large cap to mid cap plus small cap of 76 plus 22, 24, which is almost like 3 to 1. So we'll design our portfolios to have a 70-30 allocation, 70% to US, 30% non-US, and large cap to mid cap plus small cap would be ratio of 3 to 1. Further, we will use a bonds allocation of 40% and stock allocation of 60%. Of 60%, 70% is US and 30% is non-US. Of the equities, uh, large cap to mid cap plus small cap is ratio of 3 to 1. Okay, let's continue. From there, I can build a spreadsheet here with 100 is fixed here, and these are the two numbers US to non-US of 70 to 30. That's what 2.333 comes for, and from 60-40 portfolio income portion is 640, and spreadsheet computer 60 here. 100 minus 40 is 60, and US is 70%. So 70% of 60 is 42, and 30% non-US is 30%, and 30% of 60 is 18 here. And large cap to mid cap plus small cap is ratio of 3 to 1, and the total is 60 of the equities, and 3/4 is large cap, which is 45. So 75% of 60 is 45 here, and 25% of 60 is 15 here. So you can build a spreadsheet like that to figure out where everything is. This tells me what portfolio I'm constructing. I'm constructing a 60 to 40 portfolio where US to non-US is 70 to 30 ratio. Okay, and the large cap is 75% of the equities, and the mid cap plus small cap is 25% of the equities. Okay, there's formula here, there's formula here, there's formula here, there's a formula here, this formula here in spreadsheet, and this is a constant 100 here. Okay, and these are the two numbers that depend upon which kind of portfolio I'm building. Okay, let's continue.